Welcome to Coleman Report Live. I'm Bob Coleman. We're talking Main Street and the small business lender who helps it grow. John Winick in the house. John, it's been a long time since you've been on. Welcome.
Welcome. Great. Always great to be here, Bob.
And of course, Lance Sexton. Lance, as always, good to see you as well. John, give me a Clark Street Capital 101, and how is your business? Let's start with, I know you're going to give us some macro stuff. Let's go micro. How is the world treating Clark Street Capital?
I mean, it's been the best run we've ever been on, quite frankly. Since December, we've sold $170 million in UPB and loan portfolios. Every single loan, every single asset we've taken to market has sold and traded, all at or above our clients' expectations. The pricing in the secondary market for all loans has been very rich. And we're currently underwriting another $250 million portfolio of office buildings and other CRE properties that our client is a little bit worried about.
Who is selling and who is buying?
I mean, the sellers for distressed loans are typically banks, and the buyers are typically what I call professional loan buyers. For performing sales, like we've got a $8 million performing retail relationship in the market right now. The seller is more often than not a non-bank lender, and some of the securitization markets in the past 30 days have kind of gotten astray because of higher rates and Russia and Ukraine and so on. So we're seeing an uptake in performing loan sales right now as well.
Very good. From your perch, how's the SBA secondary market 7A look?
I mean, I think obviously some buyers are probably worried about buying fixed rate loans right now, but I mean, I don't see any evidence that the secondary market doesn't remain robust.
Yeah.
And why would a bank sell its portfolio? Give me a why would they do that? Tell me why.
Are you talking about any types of loans or?
Yeah.
I mean, at the end of the day, banks have to manage their capital, liquidity, and their credit losses. And I think what a lot of banks right now are looking at is you can basically get rid of any headache credit for a pretty nominal cost. Many portfolios are trading, well into the 90s. And if these loans go bad, I mean, your losses are going to be excessive. So I think it's a very favorable environment for sellers right now. And if you look at the higher costs in holding on to troubled credit and so on, there seems to be more interest in banks in exercising that. I have a friend of mine who's at one of the big four banks, and he scratches his head. He doesn't understand why every bank just doesn't sell every single troubled credit. Just because when you actually look at the other options, it makes the most sense.
So take your loss now and move on and don't worry about it is, in summary, is that a fair assessment?
Yeah, I think what holds people back sometimes is one of two things. One, they think that they're selling at like a massive loss and they're leaving a ton of money on the table. The average buyer for a distressed portfolio now is underwriting to a 7 to 8% yield. I mean, that's hardly a home run. And the other thing that holds them back is there's this false perception that there's a reputational risk in selling troubled loans when it's actually the opposite. The banks who sell more troubled loans have better reputations than those who don't. Not to say there's necessarily a cause and effect, but there's certainly no evidence for the relationship impact.
Very good. Thank you for that. Lance, did you want to jump in?
Well, I was just going to say John makes an excellent point. Having been somebody who's been through liquidation on a huge number of loans in my career, taking a 6, 7, 8% haircut is a lot less expensive. It allows an institution to define the loss, which I think is real important. When you go through liquidation, it's always going to be a more substantial reduction than that, say, 7 to 10%.
Very good. This just in, the House passed Restaurant Revitalization Fund. I have to admit, gentlemen, that this is off my radar. We're 2 years post-COVID, 2+. What's going, John? Who knows what's going on? I don't know. John, do you know what's going on?
I mean, I think this is all a terrible idea. I think, as I said in my blog this week, Larry Summers was right. He warned the Democrats early last year that the stimulus programs were inflationary and were going to be bad for the economy. And, you know, one thing I'd say about restaurants is everyone knows of a restaurant location in their hometown that fails every 3 or 4 years.
Right.
And guess what happens? Another restaurant opens up. I have no doubt that there will be plenty of restaurants. And I think, you know, this Restaurant Revitalization Fund in the first place was a bad idea. But I guess now that you've given windfalls to some restaurant owners, you got to give them to everyone else. So,
well, that's not an insignificant number, $42 billion, and that's a big number.
Well, I think the biggest thing about this bill, John and Bob, is there were quite a number of applicants that never got processed. People that submitted for restaurant revitalization funds had their applications in and never got processed and funded. Now, I don't think this will pass. And I tend to agree with John. Maybe a year and a half, 2 years ago, Bob, this was necessary, but now the water's already traveled under the bridge. Like John said, that restaurant that needed it is probably already closed and new ones opened up in its place.
Yeah, very good. John, let's see, real quick. We're in a rising interest rate environment. We understand that. We don't understand. No one knows how much it's going to rise. How does that affect the local Main Street business, the florist on Main Street?
Sure. Well, I mean, first of all, we've been in a highly, what they call accommodative interest rate environment for a long time. And I am very critical of Chairman Powell. I think he'll go down as perhaps the worst Fed chair in history. He was trying to raise rates, and the President Trump kind of goaded him from doing it. And not only did he keep rates too low for too long, but one, he encouraged Congress to pass stimulus bill after stimulus bill, and then he spent a year and a half denying inflation. So, you know, higher rates, how do they affect the florist? Well, I mean, higher rates do reduce demand, and people are going to have less money to spend. If you look at the simple analogy of a home purchase, right? I mean, if you take the mortgage rate from January last year and go to today, it's about a 20 to 25% increase in your mortgage payment, which right now, it's not as if you can buy a cheaper house. I mean, home prices continue to go up, but that's a big increase. So let's say you waited a year and a half, you bought the same house, got the same mortgage. Well, I mean, your payment just went up 20%, and that's less money to spend at the florist.
Yeah.
Very good. Let's see, and what are we talking about here, John?
Well, I think so. Keep in mind when we say that the Fed has been accommodative, you don't get to normal until you get to a Fed rate of about 2.4%. That's basically the level where the Fed is either stimulating or restricting the economy.
And where are we today? Where are we today?
We're at like 50 basis points. So yeah. You're basically 200 basis points away to get to basically break even. And if you think about it, they only meet 8 times a year. They just did a quarter point. I mean, they're going to have to raise rates in larger increments and at faster levels to really get this under control. You listen to the Fed minutes, and more of the governors are getting hawkish on inflation. So, you know, I've been saying for a while, rate increases are going to be greater than anyone anticipated, And as Larry Summers, who's been right throughout all this, pointed out, it's almost impossible to get inflation under control when it reaches certain levels without causing a recession. So the chance of a soft landing, I mean, we'd all take it, but the chances of a soft landing isn't great.
John, I appreciate your insights. My only comment is when I was a junior banker, the Fed fund rates was 17.5%. Yeah. So how does that reconcile?
Well, I mean, keep in mind though that back in the early 80s, the debt levels, the sovereign debt levels, the debt levels really across the economy were significantly lower. Right. So the rate increases, while painful, affected a smaller basket of debt. The tough part now is we've got so much debt that these increases are more painful. I wouldn't surprise me if you're seeing interest rates, the prime lending rate gets to 8%. I mean, it wouldn't shock me because got to get this under control. I mean, this is like, once in a generation level of inflation.
Lance, we're doing a webinar next week on cash flow, calculating cash flow the SBA way. Real quick, give a little preview. How much do we need for a reserve for calculation?
Well, I was thinking, and some of the comments that John has shared with me, at least a 2% shock, maybe it sounds like maybe more would be appropriate. It's been a long time since lenders have had to, maybe some have calculated it, but they've kind of done it just as an exercise, but it's serious now. If we get a 2% increase in the Fed rate, 2% increase in prime, which is going to be a 2% increase in all these variable rate SBA loans, there are a lot of businesses that can survive at 6% that may not be able to survive at 8%.
Or 9%, 10%.
So yeah, 9%, 10% underwriting and stress testing the small business's cash flow is very, very important. So given the information I've seen today, Bob, I would not, I encourage everybody, shock it at least 3%.
Hey, Raman has a question. I don't have the answer. Can EIDL loans be used to pay government guaranteed loans such as 7A, USDA, etc.?
The answer to the question is kind of convoluted. So EIDL loans are supposed to be for working capital. Working capital is not paying back federal loans. However, you use your EIDL loan to pay your payroll, pay your utilities, and maybe that frees up other cash flow to pay your debt. So, I mean, the EIDL loan has a positive impact on the cash position of a small business where they can use the EIDL funds to cover working capital needs and maybe use funds that would have been used for those working capital needs for, taking care of debt. I try to encourage everyone. Now, I'm not an end-all expert on EIDL, Bob, but I try to encourage everyone. If you get an EIDL loan, put it in a separate account and make sure you can document that you've used it for working capital.
For payroll, that'd be a payroll account, et cetera, et cetera. Very good. Hey, Delaney, are you here? Are you with us, Delaney?
Hello.
Hi, Delaney. What is President Gloria doing submitting 153 applications for 111 entities? She must be a great entrepreneur.
Yes, very much so. Applied for 44 million, managed to get 32.5 million across 111 different businesses, 153 applications. She personally received a little less than 2 million though. Somewhere along this scheme, she had a co-conspirator for a $1 million loan. Her and this co-conspirator managed to launder it through a bank account.
And she pled guilty. What is she? Do we know she pled? So we don't know what she is.
No, I'm not sure.
You know how much the government recovered from Gloria?
That is not stated either. I know she faces up to 30 years in prison,
Yeah,
plus another 10 for money laundering.
Yeah, 32 years. She'll get a good 7-8 years.
Oh, yeah.
Delaney, what we reported today, and what is the significance of your reporting of the FDIC banning bankers from the industry? Explain.
Well, for as long as I've been here, I have not seen anything quite like that. The Federal Reserve permanently banned 6 different bankers. They all committed EIDL fraud. So I'm not 100% sure about the significance of this case in particular. I'm not sure if they were all correlated. I have to assume so. But I know that they can't have any communication. They're not going to have any future job opportunities in financing, banking. I mean, this kind of shut down their career, essentially.
Lance, you've been around a little bit longer than Delaney. How often have you seen this happen?
Back in the Great Recession, Bob, when the feds were going after bankers and not after borrowers, I saw quite a few bankers be banned from participation by FDIC, OCC, and other regulating agencies. Haven't seen it, Bob, probably in at least 10 years, but you know, these people jumped out and got an EIDL loan for what, Delaney, $10,000, $15,000, and now they don't have a career. They're banned from participation with any financial institution. They can't even be, you know, they were, I don't know what their positions, but let's say they were a lender. They can't even be the janitor at a financial institution.
Well, they were with Merrill. They banked the 2 Bank of America employees. They were with Merrill Lynch, their wealth management people. So.
Yeah, I mean, I've typically seen I haven't seen the Fed do this, but it's typically been the OCC, FDIC, and I had a client that was banned from banking. You know, it's very serious. It's absolute. I don't know of anyone who's been unbanned. So it's very serious.
John,
Go ahead, Lance.
I too had a friend back in the Great Recession that got banned from participation with a financial institution, and they never overturned. He's still banned from working for a financial institution.
John, what does that mean? Do you know how extensive that ban is and what exactly it entails?
Yeah, I mean, as Delaney said, I mean, I don't know the janitor example is accurate, but I mean, I think it's pretty much any position at a bank. I mean, certainly any officer, lender, any position. So.
What about a non-bank lender? Can they go to a non-bank lender?
Yes. Yeah. I mean, nothing stops them from going non-bank lender. And I know people who have been banned who've worked at credit unions. So, I mean, there are, I mean,
Still,
I wouldn't call it a death sentence, but it's certainly a pretty serious thing. And you do become toxic. I mean, I know of a company where they had an executive that was a non-bank lender, and you know their warehouse lender had a real issue with it. So
yeah, absolutely. Let's finish up, Delaney. Mr. Maxwell, what did he do?
This is another one of those big stories where you get a couple people in a group. All of the co-conspirators already previously pled guilty. Maxwell finally pled guilty this week. They all worked together to obtain over $30 million in PPP loans, of course, lying on the applications and whatnot, trying to maximize the loan proceeds they could receive. So, of course, they eventually got caught for that. They managed to obtain $4 million, I believe. And they were, I'm assuming, laundering it to different bank accounts within the United States and outside of the United States. Beyond that, though, 2 of the members of this conspiracy group were also submitting fraudulent EIDL loan applications. And this one was interesting because they were using these social security numbers belonging to minors, and they got about $2 million off of that.
Yeah.
I mean, I was on a LinkedIn argument with a prominent lobbyist who heads up the Consumer Banking Association, and it was just one of these pieces where you congratulate the whole banking industry for PPP and so on. I said, well, there was $80 billion worth of fraud in PPP. I mean, I know it wasn't the bankers' fault necessarily because they were not asked to really do anything. I mean, except process the application. But
well, the big difference. I'm sorry, John. I was saying the big difference between the fraud today and the fraud during the Great Recession is here. They're going after the borrowers and they're going quickly. I mean, we're still talking about. There was a banker who was just, his appeal was exonerated 10, 12 years later. So
yeah.
I mean, talk about destroying lives.
I mean, if you add up the unemployment fraud and the PPP fraud, I mean, you're talking $200 billion. I mean, it's like
A lot.
a lot.
But again, it is overall it's sad, but it is manageable. It's not something that's going to take the program down. Hey, Lance, real quick, give a preview of what you're talking about next week, or I guess in 2 weeks.
Well, we're going to talk about proper underwriting of the cash flow of a small business for an SBA credit memorandum, and it becomes particularly important because of the economic environment that we're currently in and will be in. John, I don't think this ends anytime soon, so we're going to be in a rising rate environment, and it's been a long time since I could actually use that phrase, a rising rate environment, for some time. So some of the small businesses, we talk about debt coverage ratios of 1.15. Well, something that cash flows on a 6% loan at 1.15, if we get up to 8, they're underwater. So we want to properly underwrite and calculate cash flow.
Lance, you notice the segue we did, we're doing cash flow, and oops, if you make a mistake in the cash flow, then we follow up with Lance and how to do the PDK.
Absolutely, Bob. And I've been preaching Bob Delaney for some time that special asset servicing is going to become so critical to small business lenders, and it is. So you need to know how to prepare a PDK.
And I would add to that. I mean, I think you also have to look at, does that business have pricing power? Have they been able to? Will they be able to continue to pass on the higher costs to their customers? So, look, I mean, if their interest rate expense goes up, but the revenue goes up 20%, they can manage it. But
and wages, gas, and everything else. Yeah, absolutely.
Yeah, it makes me think about McDonald's, guys. Who would have ever thought a single meal at McDonald's would be over $10?
Yeah,
it is.
It is. I know.
They had a comparison in inflation for forever. The price of a slice of pizza in New York City, and the price of a Subway token has always been like identical. And recently, pizza prices have gone up. They're now like 30 cents more than your average Subway token.
I had not heard that. Hey, apologize for going over. Great conversation, John. I always appreciate your insights. Please come back often. Yeah. And we love to hear that. Everyone have a nice weekend. Thank you for joining us today for Coleman Report Live and supporting America's Main Street, one entrepreneur at a time.
Have a good weekend.